Evan Lucas. He's a Chief Market Strategist at InvestSmart. Evan, good to see you. A big week of data, really. Jobs, consumer spending. How's the economy looking in the early weeks of 2020?
Look, Laura, I think you probably need to put a little bit of a caveat on all of that answer. And the reason for it is obviously the fires have been a big impactor. So, yeah, talking about your consumer confidence numbers that you just alluded to, they are the worst we've seen in 3.5 years. That hit 93. And why I say that number, the way Westpac does it is that 100 is basically even or equilibrium. Above that, it's optimism. Below that is pessimism. And that clearly shows that we're quite pessimistic. It's particularly along things of future economics, the state of the family household, the right time to buy anything basically below a house is all seen as quite pessimistic. So that's there. And that really did fall off a cliff in December when, you know, the New South Wales fires were really going before it really hit the whole country. So not surprised to see that as well. But if you actually look at it on a blended basis, look at it on a trend basis, it's been declining basically since around about June last year. And some people put that down to the RBA and the fact that the RBA is cutting rates. We have been conditioned basically since the John Howard era that raising rates is good for the economy and falling rates obviously is bad. And that's to some extent correct, but at the same time there are other reasons the RBA is doing what it's doing. You've talked also about today's employment numbers, and the reason they're also interesting is that there has also been a trend for the first time in about 3 years that actually employment is going actually the wrong way. So we've actually seen a huge employment boom in terms of actual jobs created, but unemployment is stubbornly high at around about 5.2% and is likely to probably hold that today. The other thing that's happening is that what we call the underemployment and the underutilisation. So that's those that are unemployed and those that are employed but are what we call underemployed, where they actually want more work. If you put them together, it's around about 13%, and it needs to be more along the lines of about 7.5 to 8 to see meaningful numbers and movement on wages. So all of that is why. Plus, the other thing that we never talk about is participation. Participation is at the highest rate we've ever seen in most places. Female participation is at a record. There's arguments why that could be in terms of older population still working, more women having to work because of their current scenarios, all of the above. But that therefore means for every job we've created over the last couple of years, there's actually one person coming back into the market, and therefore it doesn't move the dial. So it's an interesting sort of plate of why we're actually where we are. It has been good, but what has started to happen is that actually the employment growth is slowing down. Those jobs we've been creating is slowing down, but participation is still up, and that's why underutilisation is still very high.
I guess in terms of a whole melting pot, this all feeds into the next RBA meeting, doesn't it, Evan?
It does.
The expectations that there will be another rate cut in February. Tim Wilson on the show yesterday saying that there shouldn't be another cut. But what are the expectations there from your eyes?
Expectations are at about 62%, according to the market, that now on February 6th we'll see a rate cut. Sorry, February 3rd we'll see a rate cut for 2020. Look, there is that push and pull around whether or not it's actually going to be any, the amount of use on it. The idea and the adage always is related to, if you push at one end of the stream, does it move the other? Clearly not. What and why employment's now become so important is that it's been used as the reasoning for the 3 rate cuts we saw in 2019, and basically why the expectation is that we'll probably see another 2 in 2020. And that has certainly not been the case. Normally it's been, look, we've seen employment do X or we've seen the economy do Y, but overall core inflation, which is the number one mandate they'd have, between 2 and 3% hasn't been reached or is being reached is the reason for it. So employment now is actually the dual mandate, and that's why it's watched so closely. So a further decline would therefore back their justifications through June, August and September to see the rate cuts last year, and why expectations are in February that we will see another one. So yes, you can make the argument that you shouldn't do it, and obviously it's heating the housing market again, etc., etc. But the RBA, unfortunately, has a sledgehammer tool to basically move the economy, and that is interest rates. It hits everything and anything. And that's the issue with monetary policy, why the argument always comes, and when I always finish these discussions, why fiscal policy has to be part of the discussion, and it probably still isn't.
Yeah, and I guess that all depends too on whether the banks end up passing that on, because they tend not to do that.
Yes, well, that was very kind of you.
Yeah.
Tend not to do it.
Yeah.
Hardly ever do they pass the rate cuts.
Not in full, anyway.
Not in full.
Yeah.
Just out of interest, how's the impact of those tax cuts tracking? Is it a little bit murky, a little bit hard to see, given we've just seen the the Christmas period?
Partly, Laura, it's coming. The thing that's always been argued is that the phase one was not the largest part of the phase. So that 1,080 that you got as a couple is there. The stimulus may have actually been seen, probably actually, if you look at the consumption through November. Don't underestimate how much people's consumption is changing through things like Cyber Monday and Black Friday sales. They are clearly there. And there was a bigger spike this year than we'd seen in previous years. The argument being from the government anyway is that that's clearly coming through from their tax movements. Phase 2 and phase 3 is where the stimulus will really come. The fact that obviously you therefore get a consistent, constant change in your overall tax rates rather than some form of tax back that we got with with phase 1. That would be where it happens. It's not a huge amount of money either if you look at it in terms of what overall effect it has on the economy. And that's why you won't see it yet.